The 294th meeting of the Central Bank's Monetary Policy Committee was held between March 25th and 26th. At the end of the meeting, the committee announced in a communique what its decisions were. It raised the MPR by 200 basis points, adjusted the asymmetric corridor, and increased the CRR of merchant banks from 10 to 14%, while retaining the liquidity ratio at 30%. While providing more insight into its current activities, it patted the Apex Bank on the back for stability in the foreign exchange market and also noted its effort in offsetting verified foreign currency obligations. Additionally, it urged the federal government to continue its interventions in the agricultural sector, as this would go a long way in addressing inflationary pressures in the country. Well, for more on this, I am joined by Gbemisola Alonge, Consultant Africa Practice. Thank you, Gbemisola, for joining me today.
Thanks for having me. Good morning.
Good morning to you too. Well, tell me, did you expect a hold or a hike? I mean, what has been your reaction to this news so far?
Yeah, I expected the Central Bank or the Monetary Policy Committee to increase rates because of the position of the MPC from, its first meeting. So if you notice from the first meeting, the committee was really big on establishing or reining in inflation, essentially. So inflation at the moment is at its highest in over 2 decades. So there's a need to, make big, bold moves to rein in inflation. And the MPC hasn't shied away from expressing that is what their goal is, and we're seeing more of that. So yeah, I was expecting, after the first of its kind rate hike from the first meeting last month, I was expecting yet another hike, but certainly slower than the previous, and that was what we saw.
Okay, so if I get it correctly, were you expecting as much as 200 basis points or 125 basis points or 100?
I wouldn't say what exactly what numbers I expected, but yes, I was expecting it to be slower than before, but it hiked nonetheless.
Absolutely. Well, there are many analysts and, of course, businesses, especially SMEs, who will tell you that rate hikes have not effectively dealt with inflation in Nigeria. And then for them, they would say that the last rate hike probably resulted in more inflation, when you look at the numbers. So on the other hand, we have financial market analysts who have said the CBN must control money in circulation. So how do we balance these extremes?
Okay, so first thing is, whenever a decision is made, there's typically a policy lag. So the period between when the decision is made and when the policy starts to take effect in real issues or real factors like inflation. So according to a study carried out by some researchers and I believe a senior economist from the CBN, it takes about 20 months. The transmission lag for the monetary policy takes about 20 months for it to start to influence inflation in Nigeria. So that's one thing that we need to note. Another thing is, in Nigeria's inflation, according to a study by the IMF last year, Nigeria's inflation is mostly affected by supply chain issues. So 40% of Nigeria's inflation is influenced by supply chain issues. And then, I think about 18 or 20% is actually influenced by monetary policy issues or money supply. So first thing that we need to note is a lot is involved in, reining in inflation in Nigeria. And another thing is that it doesn't happen immediately. Now, if the central bank or the Monetary Policy Committee did not increase rates, what we would have seen was that it would most likely have increased, the inflation would most likely have gotten worse. And that is based on a counterfactual study that the CBN actually conducted last year. So around August or September last year, the last MPC meeting before this year's MPC meeting, what the CBN or what the MPC noted was that based on a study carried out by the CBN, if monetary policy rates were not increased, we would have seen inflation rise to 30% as early as last year from when it was 22%. So first thing to note is the monetary policy rate actually influences inflation. Okay. However, it takes a while. There's typically a lag of about 20 months before we start to see it start to influence.
Gbemisola, let me come in here. While we have this 20-month lag, we note that it has some impact on the real sector. So how do we close this gap?
So it does have an impact, but then, like I said, inflation is a contributor. fiscal and monetary policy factors contribute to inflation. So one thing to note is that the federal government also has a role to play in reining in inflation. The Monetary Policy Committee and the central bank, through its foreign exchange policies or reforms in the last 3 months, has been trying to basically influence or restore investor confidence in the economy. And we're starting to see that happen. But beyond that, the federal government must also sort of basically induce growth in the economy, while the central bank or the Monetary Policy Committee basically reduces how much inflation is happening while growth is being induced in the economy.
Well, I guess your response, of course, tallies with what the MPC said. They talked about, how that food inflation contributes a lot to Nigeria's inflation, and they are saying that they would like the federal government to do more to address food insecurity and all of that. So, yeah, I guess we're on the same plane. Now, let's look at this. Let's take a look at, other decisions of the MPC. They adjusted the asymmetric window to plus 100 and minus 300 around the MPR, as against plus 100 minus 700 during the previous MPC. What does this portend?
So typically, the asymmetric corridor is essentially aimed at controlling how much liquidity is available for banks. So the MPR determines how much the banks can lend or save with borrow from the central bank or save with the central bank. And so basically reducing that window means that the central bank is essentially, or the Monetary Policy Committee is trying to reduce how much liquidity or how much leeway is available for banks to basically borrow. So reining that in, I mean, it's been plus 100 minus 300 for a while now. So reining that in is essentially the CBN's way of still controlling inflation, reducing how much liquidity banks have, and as a result, how much they can lend out to other members of the economy.
I like what you just said about, reducing the liquidity in the bank. And if we're looking again at the CRR for commercial banks, we've seen these banks borrow up to 24 trillion naira in the first 3 months of 2024. If you ask me or some analysts, they will tell you this is a telltale, sign of illiquidity. Do you think it's still sustainable to leave the CRR at 45 and still keep on, tightening and ensuring that we reduce liquidity in the commercial banks?
So one thing we need to notice, these contractionary monetary policies, so the rate hikes, they are not indefinite, right? So the central bank does not intend to leave these rates, or the MPC doesn't intend to leave these rates indefinitely. And we'll see this from what other global markets or central banks across other global markets are doing. In the last year or 2 years, there has been there's been an active fight against inflation globally. And right now, we're starting to see central banks across the world basically ease off a bit. Some have not started to reduce rates yet, but basically the rate at which they are increasing rates have started to reduce. And I believe that this is the same thing for Nigeria. We don't expect that the CRR will remain at 45% forever, but while inflation is still at a two-decade high, it's important for the central bank to make big, bold moves, and that's what's going on now. Now, is it sustainable? In the medium term, the central bank has to basically pull the brakes on how much money supply is available across the economy and how much, how much leeway banks have to conduct their business. And that's what's currently happening. I think that at the moment, in the short term, in the medium term, such bold moves have to be made, not only to rein in inflation, but also to restore investor confidence in the economy, to basically return or reverse the capital flight that we've seen happen in the last 4 years. So that's what the government, or that's what the Monetary Policy Committee is doing, the central bank is doing. And I think in the short to medium term, it still has to be done, it's still sustainable. And then as things start to improve, as inflation starts to reduce, we should see the central bank basically ease off on this a bit.
All right, we look forward to that. Let's talk about this. Now, the committee, when you look at the communique that they issued at the end of the meeting, that's the one they posted on their website, they actually sort of patted the bank, on the back for the stability we have seen so far in the foreign exchange market. There is no denying the pass-through effect, forex volatility has on inflation. However, there are some people who have said what has happened so far is not structural and might soon collapse before our very eyes if not supported with liquidity. Do you share the same sentiment?
But by what's happening? What exactly are you talking about? The federal, the foreign exchange or the MPC?
Exactly,
What
we're
part
talking
of it
about the
is not
foreign
structural?
exchange now. The foreign exchange now, where the MPC actually patted the bank on the back for the sort of stability we've seen so far in the foreign exchange market. And of course, we know that the foreign exchange market has a pass-through effect on inflation at the end of the day. So, and then there are some persons who are saying, yes, we've seen liquidity, not liquidity now, we've seen stability, and then we've also seen the CBN, selling forex to BDC, selling them to sell at a particular amount and all of that. They've said all of this really isn't structural. All of this really will not last. And they are, they're just probably scared or afraid that all of those things might just turn around, at the end of the day. What do you think? Do you share the same sentiment?
No, I don't. So what I believe is, so what the central bank has been trying to do in the foreign exchange markets is restore order. And the CBN governor has reiterated this on several occasions. So the goal is to ensure that investors have there's some sort of transparency in the market. If an investor wants to bring in their market and bring in their investments into Nigeria, they can see a clear path to which they can, repatriate their returns and even take out their money if need be. And that's why we have seen liquidity basically reduce in the market in the last 2 years. Investors have been very worried about, from 2020, what the CBN announced was that investors would need to wait to basically repatriate their funds in an orderly fashion. Now, this orderly fashion wasn't very clear to investors. We had businesses basically halt operations from Nigeria, and even we saw a lot of businesses, pull out of Nigeria as a result of, lack of foreign exchange and inability to get foreign exchange. Now, what's happening at the moment is that investors are investing with themselves. Investors are trading foreign exchange with themselves, and they're doing this at the market price. So if you need foreign exchange at any point in time, you can enter the market, the INE window, and you can get your funds at the rate that is prevalent in the markets at the time. Now, this alone reduces the pressure on banks and the central bank to basically plug in liquidity when they need to, because it's a willing buyer, willing seller method. If I want to buy foreign exchange, I should be able to basically buy it at the rate that a willing seller is willing to sell it to me. That's essentially what is going on in the markets. And this in itself is restoring investment or restoring liquidity in the markets. So, but what would have reduced inflow of investments or foreign inflows into the economy would have been if this wasn't supported by increased rates. So what is currently happening now is, beyond restoring order and assuring investors of their ability to take out money bring in money and take out money from the Nigerian economy as at when due, the MPC is then supporting it with high interest rates, such that basically the real interest rate is the negative real interest rate is reduced over time. So that in itself, basically injects liquidity into the markets. And we've already seen this. Last month, the CBN, or this month, the CBN announced that, their foreign exchange reserves were over, I think, $33 billion. That
it got up to
is
34.
showing that, investors, exactly, 34 billion. So that's showing that investor confidence is being restored, and investors are basically more eager to bring in their money into Nigeria.
Well, thank you,
so
Gbemisola.
I'm not worried at all.
Okay, thank you for bringing in that, sort of perspective. But now, beyond what the MPC is doing, which of course, to a very large extent, has to do with putting checks in place, order, and ensuring sanity, in the market. What more do you think the fiscal authority should also be doing? Because we're talking about production. That's where the fiscal committee comes in, or the fiscal authority, beg your pardon. Do you think the fiscal authority is doing enough? We've heard a lot about agriculture and even oil and gas, but is it really adding up?
So yes, indeed, like you said, fiscal policy is such a big part of reining in inflation in Nigeria, because most of Nigeria's inflation, 40%, like I said before, is driven by supply chain issues. So things like infrastructural challenges with power, transportation, and insecurity across the country. So fixing that or not fixing that will prevent Nigeria from producing as it should, will prevent Nigeria from being efficient in its production. Now, the fiscal authorities have tried to rein in inflation by first improving consumer consumption in the economy. So ensuring that businesses can still stay alive because they have consumers to sell to. But beyond that, we've also seen them basically induce, growth in the agri sector, which is still Nigeria's largest contributor to GDP. So inducing or injecting growth in this sector. But a lot still has to be done, especially in the power in the power sector. There still needs to be. Power is still a big challenge that businesses still have to grapple with in Nigeria, especially considering now that, the subsidy was removed last year. So alternative sources of power have become more expensive to sustain. So beyond, providing funds for agricultural for players and all that, the government still needs to do a lot in terms of inducing growth in the power sector, improving the transportation sector, actually unlocking. We have a train that we have train systems that were developed by the previous administration, but actually using this to unlock trade across the country is very essential. And then there's also the bit about insecurity. Businesses still have to grapple with the possibility of their staff being kidnapped or their goods being, not being able to get to its final destination as it should because of insecurity issues and insecurity problems. So until insecurity is also dealt with significantly in such a way that businesses can actually attest to the fact that this is happening, there will still be that lack of productivity or inefficiency in Nigeria. So, we commend the government for what it's doing in terms of unlocking growth and all that, but there's still a lot of work to be done.
I'll take that. There's still a lot of work to be done. Now, let's take a cue from, a country that's Kenya. The shilling went from being one of the worst performing currencies in the world to being the best, in less than 3 months. Also, inflation risks, have diminished due to the deceleration of the primary drivers, namely food and fuel prices. How did they achieve this? And are there any lessons here for Nigeria?
Okay, so I guess first place to start would be how Kenya got to where it did. So Kenya's economic challenges were driven by several things. So first was the climate change, weather changes that affected the agri sector significantly. And then we also had, they also grappled with issues around, the possibility of them defaulting on their Eurobond that's due this year. Now, the Kenyan economy was able to basically navigate this by supporting. First thing was that the weather became better, so weather issues reduced, and they're starting to see, rains return as usual. But beyond that, right, they got a lot of support from the IMF. So Kenya got funds from the IMF and was able to basically allay the fears of investors of its inability to meet its Eurobond payments, or it's the possibility of defaulting on Eurobond payments. So the fact that that is gone out of the way has ushered in investors again. So one lesson to learn is, if you notice that investors are a bit scared about your inability to meet your debt and everything, first thing is to allay those fears. And I feel like Nigeria has taken a cue from that by restoring order in its foreign exchange markets, because that was a big concern for investors. So like Kenya, based on getting support from the IMF, Kenya was able to basically roll out some new local debts that basically got investors interested again. So there was an infrastructure local debt, I believe, that Kenya rolled out in February, and that was oversubscribed. And it's a local currency bond, so that meant increased supply or increased demand for the Kenyan shilling, and that basically supported the exchange rates.
Thank you.
So I guess basically restoring order, getting investors more comfortable, and those are lessons to learn, essentially.
Thank you so much. And of course, the takeaway from here is that the CBN, or the MPC, as the case may be, has done a whole lot to restore order, but then we need to see more. That's on the part of productivity, and that, of course, goes to the fiscal authority. Thank you so much, Gbemisola Alonge, for sharing your thoughts with us today on Business Edge.
Thanks for having me.